Two, one, go live.
Hello, all. I'm Mamta Rawat from the Corporate Communications team at CareEdge Ratings, and it's my pleasure to host today's webinar on Europe in a shifting global order, reasserting its position amid challenges. Thank you for taking the time to join us. Before we begin, I am delighted to introduce our esteemed panel of speakers. Mr. Luis Diaz, Senior Economist at Banco de España, Ms. Moon Young Lee, Lead at Sustainable Infrastructure Investment at OECD, Mr. Marco Bodellini, Academician, Banking and Financial Law at University of Bergamo, Ms. Franziska Onzog, Chief Economist, South Asia Vice Presidency at the World Bank. This session will be moderated by Ms. Rajni Sinha, Chief Economist at CareEdge Ratings, and Luc Marchand, Sovereign Risk Specialist. We will begin this webinar with a presentation by Ms. Shobna Krishnan and Ms. Shivani Sahu from CareEdge Global. After the presentation, we will move into a panel discussion followed by a Q&A. For any questions, please type them into the chat panel. We will address them towards the end of the session. With that, may I invite Shivani to begin the presentation.
Thank you, Mamta. Europe today stands at an important economic juncture. While the region remains one of the world's most advanced and institutionally stable economic blocs, it faces several structural challenges that are shaping its long term growth outlook. At the same time, Europe continues to exhibit areas of resilience and emerging opportunities, even when external factors like geopolitical tensions are remaining elevated. Understanding this balance between structural headwinds, external risks, and potential opportunities would be crucial in assessing the region's economic trajectory going forward. Also, please note Europe and European Union have not been used interchangeably. Let us now begin by looking at some of the key structural headwinds facing the region. Europe's relative weight in the global economy has been gradually declining. The region's share of global GDP is projected to fall from nearly 30% in the early 2000s to around 19% by 2030, reflecting the rapid rise of emerging economies such as India and China. At the same time, Europe has been increasingly characterized as the slowest growing major economic bloc globally. One of the key factors shaping this trajectory is demographics. Europe is already the world's oldest region by median age, which has reached nearly 43 years of age in 2025. As the chart on the left illustrates, the working age population is projected to decline steadily from around 68% of total population in 2000 to nearly 57% by 2060. Migration, which has been able to cushion labor shortages across these economies, is also expected to moderate over the next decade. Therefore, it is unlikely that migration will fully offset long term aging pressures. As a result, sustaining future economic growth will increasingly depend on productivity gains rather than labor force expansion. However, productivity dynamics themselves present challenges. Europe continues to lag behind several advanced peers, both in terms of labor productivity growth and capital formation rate. Here, the chart on the left shows the growth in labor productivity has dipped sharply in Europe while it has been able to sustain in US and advanced Asia, while the chart on the right shows gross fixed capital formation rates across advanced economies and selected European economies. Even there, Europe lags behind in investment. Europe is also lagging behind in terms of innovation as it has been not able to scale up expenditure on its research and development, while competitors like US and China have been able to gear up on this front. At the same time, traditional industrial sectors across European Union are facing additional cost pressures, particularly from elevated natural gas prices, which have affected their competitiveness. Investment trends also reflect these structural shifts. Europe has seen a remarkable decline in FDI inflows in recent years, increasingly losing ground to fast emerging economies like India and China. In contrast, US has been able to attract strong and relatively stable investment flows. Fiscal dynamics present another important dimension of Europe's economic outlook. Debt trajectories vary significantly across economies. Countries like France and UK are expected to see rising debt levels, while countries like Italy and Sweden are projected to have steady debt levels. In contrast, several European economies like Greece, Cyprus, Spain, Portugal are expected to see significant reduction in debt ratios. Expenditure pressures also vary across regions. We have identified three pockets for medium term fiscal pressures, which are majorly pension spending, defense spending, and interest payments. The chart over here shows the expected cumulative gross changes over a time period of 2024 to 2030. Interestingly, countries in Northern and Western Europe, such as Netherlands, France, Germany, are facing higher spending due to higher defense expenditure. Meanwhile, southern European economies like Italy, Greece, Portugal are expected to see higher pension spending. Countries like France, UK, and Italy would face higher interest rate burdens over the medium term. Having now looked at the structural challenges to the region, we shall now focus on the structural anchors for Europe. Most of the European economies face relatively lower debt servicing cost in comparison to other advanced economies. Here the chart represents four quadrants. First being low debt and low debt servicing cost. Second being low debt but high debt servicing cost. Third being high debt and high debt servicing cost. And fourth being high debt but low servicing cost. Here we see most of the European economies face lower debt borrowing cost despite high debt levels. Another key strength for Europe lies in its strong base of high value and knowledge intensive services. Europe is a global leader in terms of services exports, reinforcing its competitiveness and sustaining its role in global trade even when manufacturing growth moderates. External balance sheets have also improved across the region over years. Many countries have strengthened their external buffers as reflected by improvements in their net international investment positions. At the same time, EU has also gained greater market share in the US. Labor market conditions across Europe have also improved significantly. Falling unemployment rates in the region reflect stronger labor market resilience that would help stabilize household incomes and support domestic demand. It would also contribute to higher tax revenues and social security contributions supporting fiscal balances. The banking sector has also undergone significant improvement since the global financial crisis and the sovereign debt crisis. Overall, these improvements strengthen bank balance sheets and enhance the effectiveness of monetary policy transmission across the European Union. I, I would now like my colleague Shobna to take us forward with the next sections.
Thank you, Shivani. Let me now take you all through the systemic risk or exogenous shocks for the region. The chart on the left depicts capital goods balance between Germany and China. Over the years, Germany's capital goods exports have declined to China, whereas that of from China have increased, leading to deficits with China for the first time in 2025. China's exports in higher value added goods like autos and machinery have driven the deficits. The chart on the right depicts the growing share of China in global exports, while that of EU has fallen. The relationship between EU and US are also evolving. Following the Russia's invasion of Ukraine and the reduction of Russian energy supplies, the EU significantly increased its oil imports from the US, partially offsetting lost volumes and strengthening transatlantic trade linkages. However, recent tariff tensions linked to the geopolitical developments, including that of Greenland dispute, has introduced new strains in the relationship and raised broader concerns regarding future trade cooperation. Post the onset of Russia-Ukraine war, defense spending in EU region has increased rapidly as indicated by the chart on the left. Defense spending has increased by 2x between 2025 and 2019. Even as the overall defense spending rise, the rise has been directed towards capital expenditure in defense aimed at capacity building. Thus, this rapid rise is expected to have impact not only on fiscal but also on the growth. Coming, coming to the recent geopolitical tensions, what are the implications for EU? EU's direct exposure for Middle East is limited, as represented by the chart on the left. As you can see, Norway and US now significantly hold a larger share in EU's imports of petroleum oils, whereas exposure from Saudi Arabia remains limited at 6%. Direct exposure to Strait of Hormuz is also limited compared to the Asian markets, but Strait of Hormuz remains vital for the overall gas supply. However, EU has high energy dependence and inventories of gas in 2026 is lower than the previous 2 years, making it vulnerable to recent oil price shocks due to high transportation cost. Let us now focus on emerging green shoots for the region. There has been change in the regional growth dynamics. Traditionally, strong economies such as Germany and France have experienced weaker growth momentum. In contrast, most of the post pandemic recovery has been driven by the southern European economies, particularly Spain and Portugal, which are currently providing a significant share of region's growth impulse. A key factor supporting this recovery has been the European Union's Recovery and Resilience Fund. The chart on the left depicts that EU has overtaken US in terms of public investment for the first time since in 2024 and 2025. Among the member states, Germany, France, Italy, Greece, and Portugal have recorded some of the highest disbursement rates in the RRF funds. However, effective deployment of these funds would continue to remain a key monitorable. Investor sentiment for euro assets have also been positive in last couple of years. The chart on the left represents total general government debt holding, of which central bank holdings have been deducted. Of the remaining pool, this line represents the share of non-resident investors. We have seen a steady rise in the share of non-resident investors' holdings for the EU. The chart on the right shows the share of euro in the foreign currency reserves has also risen. Policy responses to demographic pressures are also evolving. Retirement ages are gradually rising across many European countries as government attempt to offset shrinking working age populations and sustain labor supply. Extending working life is becoming an increasingly important mechanism for easing pension-related fiscal pressures and supporting long-term sustainability. Finally, some food for thought. Will the elusive EU growth make a comeback? That's the question we are asking. In the past, we have always seen that the dips have been followed by a resurgence in the growth levels in the economic growth. The previous episodes of growth has been driven by global trade and consumption led. However, going forward, we expect that the growth levels are going to be much muted than seen in the previous resurgence. And this time, probably the growth will be led by the investment. Overall, we have stable outlooks for most of the countries in our coverage universe. with Greece having a positive outlook. The credit outlook can be divided for the region into three buckets: risk, buffers, and tailwinds, with risk encompassing slow growth, rising debt concerns, elevated geopolitical tensions, buffers comprising of institutional monetary credibility and external deleveraging, with emerging tailwinds from support from EU and leadership in the green energy. We believe despite these challenges, credit outlook for EU remains stable. Thank you. And now I hand it over to Mamta to take it forward.
Thank you, Shobna and Shivani, for that comprehensive overview. A quick reminder to all the attendees, please keep sending in your questions. We'll take them up during the Q&A. Now, I would like to invite our moderator, Ms. Rajni Sinha, to take the discussion forward. Rajni has nearly 2 decades of experience in the field of macroeconomic research. Before joining CareEdge Ratings, she was the chief economist and head of research at Knight Frank. She has also worked with top institutions such as Aditya Birla Group, Kotak Bank, and JM Morgan Stanley. She regularly authors opinion pieces for business dailies on varied economic issues and occasionally delivers lectures at educational institutions. She is an alumna of Delhi School of Economics and Lady Shri Ram College. Over to you, Rajni.
Thank you, Mamta. And thank you, Shobna and Shivani, for a very crisp and insightful presentation. I would say the main takeaways for me is that Europe as a region is going through a weak growth momentum. The region is facing tough competition in its manufacturing sector from China. There are also structural issues which the region is facing with aging population, low productivity growth, low investment, which raises concerns for its future growth prospects. And in midst of that, there is further complication with all these global uncertainties and geopolitical conflicts that we are seeing. Europe was already struggling with high defense spending in midst of Russia-Ukraine war, and then now we have this West Asia conflict, which will further have repercussions for the region. But at the same time, as my colleagues highlighted, Europe has its own strength. It's leading in high value service sector. In spite of these challenges, it also has strong external buffers. Moreover, a lot of these EU-led initiatives like the RR facility that is also supporting investment, green transition, and structural reforms in the economy. The other important takeaway from the presentation was that some of in the region, growth is kind of varied. So while the Southern European economies are doing relatively better, like Spain, Portugal, they are leading growth in the region. The traditional leaders like Germany and France, there the growth is little muted. So with broad understanding, let's move on to our panel discussion. I'll begin by introducing you to our experts. So we are very happy to have with us a panel of experts to discuss some of these issues. So I'll begin by introducing Mr. Luke Marshall. Luke is a senior economist and sovereign risk specialist with over 30 years of experience across rating agencies, international banks, and multilateral institutions. Previously, he spent 13 years at Standard & Poor's as Associate Director in Sovereign Ratings. He later held the position of Director of Country Risk Analysis at NatWest Group. Luke is also a UNDP Africa Consilium expert on sovereign credit ratings and founder and CEO of Country Risk Company Limited, providing sovereign advisory and training services. So Luke is going to be my fellow moderator for this session. Thank you, Luke, for joining us.
Thank you.
Now, moving on to the panelists, we have with us Francisca Onsoch. Francisca is the Chief Economist for the South Asian region at World Bank, where she leads the research program on key economic issues affecting South Asia and helps inform policy debates as well as the World Bank's lending operations in the region. Before joining the World Bank, she worked in the office of the chief economist at European Bank for Reconstruction and Development and IMF. Her research spans a wide range of topics in international macroeconomics and finance. She holds a PhD in economics from the University of Toronto. Thank you, Francesca, for joining us.
Thank you. It's a pleasure.
Our second panelist is Luis Diet Catalan. Luis is a senior economist at the Bank of Spain, working in the Monetary Policy and International Economics Department, where he focuses on European and global economic policy. Prior to joining the Bank of Spain, he served as deputy director and senior advisor at the presidency of the Spanish government, contributing to long-term strategic initiatives such as the SPANA 2050 strategy, with a focus on economic growth, innovation, the future of work, and inequality. Luis holds a PhD in economics from the University of Minnesota, and his research spans macroeconomics, labor economics, productivity, and technological change. Thank you, Luis, for joining us.
Thanks.
Our
Thanks a lot.
next, our next panelist is Marco Bodolini. Marco is a lecturer in banking and financial law at the University of Bergamo and a research scientist in sustainable finance law at the University of Luxembourg. His research focuses on banking regulation, financial stability, sustainable finance, and fintech. And he has published extensively in leading US, UK, and European law journals. In addition to his academic work, he advises public and private institutions and contributes to policy discussions as a member of the European Parliament's expert group on bank crisis management. Welcome to this discussion.
Thank you so much for having me.
And our last panelist for the session is Moongyung Lee. Moongyung Lee currently drives sustainable infrastructure investment through the Blue Dot Network, focusing on mobilizing private capital aligned with rigorous sustainability standards in emerging markets and developing economies. She brings deep expertise in blended finance and renewable energy, with a proven track record of structuring innovative climate investments and developing green capital markets during her tenure at the African Development Bank and the European Bank for Reconstruction and Development. So, Moon, welcome to the panel discussion. So, with this, to begin with, I'll hand over to Luke for the initial set of questions.
Yes, can you hear me clearly?
Yes, Luke, we can.
Okay, so we will begin with a question to Luis. So how well is Europe to navigate the current geopolitical realignment and the emergence of new regional powers? And what does it mean for Europe long-term strategic autonomy? So here it's about how Europe will reaffirm itself as a economic, financial, military, and other power in the world. The presentation I've seen, we have seen a decrease in its power relatively to other nations. But what are the main elements for the future of this strategic autonomy, according to you, Luis? Please.
Okay. Hi everyone. Thank you, Luc, for the question. So I mean, I think as the presentation made it very clear, Europe is in a structural inflection point. To make a summary of the last decades, I think that the growth model of Europe that relied on cheap Russian energy, US security and technology, and Chinese market access is to some extent in each of the three axes compromised. I don't see that this situation is something cyclical. It's not a cyclical shock. I think we are something that is really changing the geopolitics and how the world economy looks. We all know that model of growth have evolved and generate a lot of dependencies. For example, 100% of the relevant cloud computing is in US hands. China supplies most of the EU heavy rare earths that Europe uses. And I think after all this, we realized that strategic autonomy, or some sort of strategic autonomy, is an economic necessity. It's not something that we can afford not to do. I think Europe shouldn't try to replicate and cannot probably replicate all US and Chinese capacities in every domain, but it should have the sufficient capacity in that areas, as you were saying, that matter most, like defense, having an industrial base, energy security, digital infrastructure, having a financial architecture that is able to attract more capital. I think this is something that's clearly identified in the EU. I think the Draghi reports make it very clear. I think it put it sort of in an existential competitiveness challenge that we are facing that definitely require higher investment push. And what we know so far in the last year and a half is that the implementation of some of the measures that would make this shift and make better the ability to strengthen the strategic autonomy of Europe are lagging, right? So that's kind of the overview that most of us, I think, we can agree on. However, I believe that Europe is better positioned to try to overcome those challenges that current pessimism seems to suggest. I think the Ukraine war, in many aspects, was a wake-up call, and previously areas that were blocked that was not thinkable to reach some agreement, like defense, not energy security, and industrial policy. We've seen some changes and some areas of advance. So I think from a long-term perspective, if I start to think about how Europe can position itself in this new world, I think its regulatory capacity and its institutional framework can become actually a strategic asset, right? In this new fragmented world, I think EU can position itself as a reliable and stable partner that is not only looking inward and looking to itself and acting defensive, but try to, again, being able to secure its supply of important domains like defense, energy, some digital infrastructure, but at the same time be able to participate in an open world. That's what I would say.
Thank you very much. I will come back to you. First of all, I would like to switch to Marco and ask him maybe if you can comment on the financial system element of that. We have lived, all of us, Eurozone crisis. And in the middle of that, we had a banking sector crisis, right? Now, the impact of the Middle East was at the moment on European banks is maybe of less of a concern because the NPL level is much lower, the capitalization level is much higher than during that time. And so arguably, as we see in the presentation, the European banks are stable and not going to be vulnerable to another crisis. Now, I'm going to ask Marco to answer to this question. Are you that sure?
So thank you, Luke. I think you made a fair point that European banks are nowadays more sound than they used to be in the past. Now, of course, this new war scenario in the Middle East is something which needs to be taken into consideration. Now, if I think about the potential impact of the military operations in the Middle East on European banks, I can, envisage at least two main types of impact. One would be direct and would entail losses resulting from open positions towards counterparties which are based in the region. And the second one would be indirect impact resulting from the indirect consequences of the war tensions on the European economy, particularly in terms of rising prices of commodities such as oil and gas, which could potentially lead to inflation. Now, in my view, this second type of impact, the indirect one, could be more relevant, particularly if the war in the Middle East were to last for quite some time. This point has been also highlighted by the ECB, underlying that there might be sort of issue resulting from increased in the energy costs. Now, back to your point about the conditions of banks. Obviously, geopolitical risk is a relatively new category of risk, but not that new in the sense that regulators and supervisors have been pushing banks to increasingly take geopolitical risks into consideration, and most banks in Europe, I think, have already started embedding considerations concerning geopolitical risk in their corporate governance structures, but also in terms of risk management, in terms of capital requirements and the liquidity. So all in all, I think that I will conclude on this question with what I said at the beginning. Banks, European banks particularly, are more sound than they used to be. The impact of the tensions in the Middle East is still to be fully understood. If the crisis were not to last for a long time, I would be relatively optimistic.
Excellent. Thank you so much. That was very clear. I think everybody understands that the baseline scenario of 4 to 5 weeks and impact on few quarter on prices of oil and gas is the main scenario that all the markets are looking at, but that the tail risk is still to be accounted for. This tail risk is taken into account in all the big banks. I worked for NatWest. They have scenarios for tail risk, but it's still to be accounted in the accounting when this probability will be more concrete. So far, so good. Thank you so much. Now I will turn to Moon and ask a complementary actually question to those questions asked to Luis about the strategy for Europe. Here is more about the infrastructure investment. Today, it's increasingly strategic for all this infrastructure investment to be strengthened in Europe, and not only to increase long-term growth, but also to really have generation of investment in the future, in fact, and the generation of growth. So can you tell us a bit why infrastructure investment, because you worked on it at the OECD, is strategic for the future and not only a source of long-term financial return? Moon.
Thank you, Luke. Indeed, I think at the moment, as many panelists mentioned, and also we saw from the presentation from
I can't hear.
Very important shift. Can you hear me now?
Yes, yes.
Sorry, there's some issues with the
No, we can hear you. No problem. Go on, please. It's freezing.
Can you hear me now? Sorry about the
Yes,
technology
yes.
today. It's not working well. But
frozen. Okay. Unfortunately, you're frozen for the audience. Maybe we will take you back as soon.
Yeah. I think we'll go back to Moon.
Yes.
Here, I would like to bring Francesca into the discussion. So, given your expertise in Moon, so we'll come back to you. Okay, you can go ahead and answer that, and then we'll move to Francesca.
Yes, apologies. There are some issues
No
these days
problem.
with IT. Going back to your question in regards to the structural or the perspective change on how we're viewing the infrastructure, is in fact indeed like conventionally we have been seeing infrastructure as more defensive asset class, mainly because it's valued for stable cash flows, inflation protection, and predictable long-term returns. But because of the paradigm shift in the market is taking place more into take a consideration of economic slowdown and challenges on labor force changes, as well as debt level. We're now shifting more toward the value creation, meaning that infrastructure is seen as strategic pathway to enhance the productivity, enable the industrial transformation, and also build the economic resilience. Now, that's also shifting how the investors are valuing the infrastructure. So when we're valuing the infrastructure, we have been relying on projected cash flow over time. But now investors are paying much closer attention to what they call the terminal value, essentially what the asset could be worth when it is sold in the future. So in other words, investors are increasingly consider how attractive the asset will be to future buyers at the exit. And because this attractiveness of the investors are very much relying on future proof, meaning that whether the asset will be operation resilient, but also it will be aligned with evolving economic changes or standards around regulation and sustainability. Give you example, the asset, for example, is not aligned with net zero scenario. Now, it may carry a certain risk of carbon locked-in effects, and that will pose significant impacts how we are viewing that asset. And it might, in 10 years or 15 years time, the asset became stranded asset, and at the your terminal value could potentially near zero. And that's why the quality and sustainable infrastructure became really the center part of driving how we are seeing infrastructure value, and why it became more than financial return itself. The way infrastructure designed, operated, and governed is going to be more increasingly determining factor whether it commands a premium valuation in the future. And often the investors are looking into how you can align with investors' expectation in that sense. And that's why the work we are doing at the Blue Dot Network at the OECD comes as catalytical in a way that it gives a way to align your projects or infrastructure to be achieving the international standards, as well as mitigating the risk, thereby became future-proof assets. So on top of that,
to interrupt, Moon, can you confirm that this investment in AI and data center might be a good example of these infrastructure investments in Europe?
Indeed, but at the same time, we have to bear in mind that current AI boom is interdependent with other types of infrastructure. That's why just simply mobilizing capital itself is not sufficient, and it has to be approached more organic way of understanding the interdependence different sectors. For example, if the AI to be enabled, you need to able to have a secure energy supply. So energy infrastructure has to be also scale up at the same time. And that kind of strategic approach will be critical. And that also linked to the national security and sovereign resilience. And that's why the infrastructure became more than financial return, but consider it as a strategic approach nowadays.
Thank you. I hope some people in the EU is listening to us. There are plenty of policy to implement on international and national level on this front. Thank you so much. Maybe Rajani with Francisca?
Yeah, I wanted to get Francesca into the discussion. Francesca, given your expertise in South Asia, how do you see the whole thing impacting what we are seeing in terms of, all these uncertainties and the trade war and the geopolitical conflicts? How do you see all this impacting the economic relation between Europe and South Asia in terms of trade linkages, investment linkages? How do you see all that getting impacted going forward?
Yeah, for South Asia, links with Europe are a fantastic opportunity. So Luis already mentioned a stable partner. So there's the politics, but there's also the economics. If you take, for example, India, it had trade agreements before this mother of all deals, which was just agreed a couple of months ago. It had trade agreements with countries that account for about 10% of global GDP. That's not a big export market. Yeah, so that compares with kind of 60, 70% of GDP for global GDP for Mexico and Vietnam. Now, those are big export markets. What this trade agreement with the EU, for example, has done for India, it's basically tripled access to global markets. Now, India has special agreements, trade agreements with countries that account for about 30% of global GDP. That is an amazing opportunity. So what we've done, we've estimated a bit what would be the impact of a trade agreement like this. Yeah, it'll be good for GDP growth, for India especially. I mean, well, for South Asia in general. It's good to lower these trade barriers. But what comes on top of that is that India itself is implementing a whole host of other reforms that will make it much easier to actually take advantage of this new access. So deregulation, labor market reforms, trying to make land markets more efficient. So when we take into account, when we then model what might be the impact of this package of reforms, both the trade opening plus these reforms that just make it easier for the economy to adjust, we see that the GDP gains could be double of what it is compared to trade reform alone. So for South Asia or India, there are big opportunities. And these opportunities are also, if you want to take a bit more of a less macro view, or more of a meso view, a sectoral view, these tariff cuts that come with the agreement are exactly in the sectors where India has kind of mid-range revealed our comparative advantage, where it's not already leading, but where it's kind of in the middle. It's not far behind, but it's kind of in the middle. Revealed comparative advantage is kind of in the middle. So exactly the sectors that have potential. So for Europe, for India, this is a great opportunity to sort of integrate into global value chains, to integrate into global markets. And for Europe, it's a great opportunity to have access to a very skilled labor force. So India, for example, India is large. It has many unskilled people, but because it's so large, it also has many, many skilled people. And they can fill holes that Europe in itself cannot fill by itself. So we've had interactions, for example, on these global skills partnerships across South Asia, not just India, that can help fill exactly the kinds of holes that Europe has. So there's the famous nurses, of course, but there are also software engineers. I'm glad that Moon Young mentioned the AI industry. So AI is wiping out jobs all over South Asia now, but it's also creating opportunities for other types of jobs. And the same in India, so in Europe. If Europe can then draw on some of this Indian expertise, there are big opportunities that create win-wins for both. Back to you.
Yeah, absolutely. In fact, with the global trade slowing down and so much uncertainties all around, there is huge expectations, and this trade agreement should be a win-win for both the countries. Let's see how it pans out going forward. Back to you, Liu.
Sorry. I'm back with a question to Luis. So it's a complementary question on Europe place in the world, and this time it's about this low growth, medium-term growth that is weak. And at the same time, we have this coming up, as you saw on the chart, public spending increasing in defense, energy security, aging, innovation, and interest payment. So decreasing fiscal space, basically, and still low growth. And so it's limiting the public possibility to have an impact on growth with public spending. So whole will be on the shoulder of the private sector to increase growth. So what are the possibility to increase growth in the private sector? That's my question in Europe.
Okay, thanks. I think this is probably the central question right now for European economic policy, at least in the short, medium term, right? As you were saying, now we're facing a situation where we need to invest more in defense, in energy, climate transition, innovation. We need to consolidate our public finances, and we still need to protect social spending, right? At the same time, we're facing aging population. So I think we need to set priorities and to think of strategies to revamp growth in Europe. You were asking for the private sector, but I want to start with something that here at the Banco de España we think is the first priority, and that it could be really have a huge and sort of immediate impact. That will be a move decisively towards a permanent common EU financing for European public goods, right? You were pointing out how fiscal space in Europe is limited and is also unevenly distributed across states. And what we were talking before, we're facing huge investment in defense, climate, and we don't have that fiscal space on national governments, right? So we saw how the next gen EU funds work and were effective to revamp investment. And I think permanent sort of joint financing instrument will be able to improve reasserting, to lower the funding cost, and to be able to enable to scale to the large scale investment that Europe needs. That would be my first priority. But I think there are other things that need to be done. One thing would be to try to push for growth and hastening low-cost structural reforms. For example, the Draghi report talks about 40% of those related with regulatory simplification, with single market deepening, governance reforms. The savings and the union investment is also critical to try to have a less fragmented capital markets. Those are things that don't need extra government money and can be very effective in the medium term. Then we have also have a now growth-friendly consolidation path where we are not as strict on the static position of each country, but it matters more what is the consolidation path, what the reform that take in the medium term. That's also that is giving some space to countries to invest and not to just think on expenses. And the last thing is the glory. The most important thing would be to try to revamp productivity. That would be the actual good, the ultimate fiscal tool to revamp growth. No, if we can reduce the productivity gap with the US to scale innovation and to do this, then that would be fantastic. For
That's
growth,
excellent, because that gives me the link to my last question to you, Luis,
Okay.
before I turn to Marco, is how to really with this problem of competitiveness of Europe for some product, especially vis-a-vis China, but other South Asian countries. How do you think that Europe has to direct its policies industrial policy in order to retrieve some competitiveness?
Okay, yeah, I think that's also very important, and I want to be short and clear. I think first, green transition and competitiveness should go together, not sequentially. Okay, we've seen how decarbonization can be a weapon to decrease the dependence of energy, and I think is the long-term industrial strength that Europe may have. Then we need to do, as you were saying, a smart industrial policy, not subsidy races. We cannot match China euro for euro. We should be smart, we should be targeted, we should leverage on the strength that we have, regulation, trust, research, and the single market. I also think it's important to also introduce some non-price criteria, such as sustainability, data security in procurement, that also be a structural advantage. And the last thing I think to reckon on all this is that the full battleground is the full value chain, right? We need to be able to control and to better to have a more resilient value chains. We know that I think only 6% of the EU firms have a visibility beyond 2 tiers. So we need some innovation there so that we are able to identify and reduce those dependencies. And that will be my 3 points about this.
Thank you so much. There's plenty of opportunity for Indians to continue to have agreements in pharmaceutical and distribute cheap tablets to Europe also. I'm sending an idea here. Among other products, Indians can produce many things and much more than people think. Then this partnership is very, very essential to increase competitiveness on both sides, actually. Last question, because I have to leave in 8 minutes, to Marco. With EU slipping behind the US and China, despite the strong talent and SMEs, to what extent are political outreach, over-regulation, or climate compliances, sometimes people say, is driving Europe's productivity decline? So that's the question. What is behind this productivity decline? What is the part of the regulation and public sector?
Yeah, thank you, Luke. Let me start by remarking that actually productivity in Europe is, in fact, a problem. But though there are, I think, a number of structural elements contributing to this situation, and just to name a few of those structural elements, I would point to fragmented markets to a large extent, weak scale-up financing, slow diffusion, or at least slower than needed of new technology, obviously energy costs, and aging population, which was already referred to several times during this panel. Now, with regard to fragmentation, along with compliance costs resulting from intrusive provisions, the main issue is that those two combined elements affect the most small and medium-sized enterprises, which are, as it's well known, the backbone of the European economic landscape. And of course, that is an issue because having to deal with those problems, SMEs economies cannot grow as they should to access global markets. The other issue which was mentioned before is this misunderstanding about sustainability, sustainable finance, and climate change fight, which often in the narrative is presented as an issue impacting competitiveness. That shouldn't be the case because climate and environmental degradations are in fact an issue which should be tackled despite the need to be competitive and the need to compete with other economies. Let me spend just a few words to try to identify some ideas and policy remarks to try to at least tackle some of those issues. Obviously, as it was mentioned before, the incomplete single market is a drawback which should be tackled. Market integration within the European Union is crucial, as was correctly pointed out both in the Letta's report and in the Draghi report. There are a number of regulatory initiatives which have been recently presented by the European Commission with a view to further integrating the single market, particularly with regard to financial services and banking services. I'm talking about the Capital Markets Union, the Savings and Investments Union, the Retail Investment Strategy. All those initiatives should be finalized as soon as possible. Then, of course, we have an issue in terms of energy production and energy costs. There, I think a combination of public and private investments will be important. Aging population is an issue which is featuring not just Europe, but I would say every developed jurisdiction in the world. And again, even in that respect, a number of new policies will be very much needed in order to give back to Europe the productivity which is very much needed. Thank you.
Absolutely. Thank you so much. I will have to leave you, all of you, and give the hand to Jenny and colleagues to finish the call. Thank you so much, everybody.
Thank you, Leo. Thanks a lot. I think we'll move to the question answer session. We have very little time, so I'll just take some questions from the audience. Let me just look at the chat box. Okay, so there is one question that I would like, maybe Moon, you can look at that question. So Marco spoke about this, lower productivity and aging population in this whole region. So what do you think needs to be done in terms of reform, or what can really help Europe in this regard in the coming decade?
Thank you, of course. As I mentioned, I think there is a growing importance on infrastructure investment, meaning that related to more of a economic resilience and enhancing the productivity. And for that means we have to invest a lot on rolling out infrastructure in different sectors. And there is a growing new area where we need to focus, which is the digitalization part. But the commonality of this different sectors of infrastructure needs is really about stabilizing and securing the supply chain for critical minerals. If you look at infrastructure of the electric vehicle or energy or digital, we really need to have a reliable and sustainable supply chain of the critical minerals, whereas at the moment, this supply chain is very much concentrated in one region. For example, China controls roughly 80% of rare earth mining and about 85% of processing capacity. So for the priority, I think you really have to invest on securing the autonomy of the supply chain and diversifying the risk. Also, one way to see it is to also invest in circular economy infrastructure where you can reuse and recollect those critical minerals. And in parallel, I think it has been echoed several times by many speakers today and throughout the session, is really about private capital participation. In the past, a lot of infrastructure wave has been done by public-led initiative, like looking into stimulus package after the economic crisis and COVID-19. Really the EU or public finance has been leading the role. But considering the vast amount of needs, it's really the time that we have to looking into how we can mobilize better for the private capital. And that being said, for Europe, leveraging its strong institutional capacity and framework, reliability from the investor side and the confidence toward the market. And I think CareEdge presentation mentioned also about growing preferences around the euro denominated assets to diversify the risk from the dollar portfolio. So I think leveraging this strength and also prioritizing the security supply chain for the critical minerals to deploy the infrastructure, therefore is securing the productive economic growth with the resilience will be something that we really have to focus in my opinion.
Yeah, thank you, Moon. That's a very important point you've highlighted. In midst of all these geopolitical conflicts and global uncertainties, securing autonomy becomes very important, not just for Europe, but for all other countries and regions. So with that, I'll go with the last question to you, Francesca. Global demand is changing. Demand from emerging economies is increasing. In that scenario, how does Europe need to reorient it to ensure that they remain competitive in these markets, in emerging economies, in South Asia?
Thank you. Yeah, that's something that everyone faces, not just European countries. The whole world is slowing. So for any export-led growth model, it's going to become more difficult, which goes back to, I think, what Marco mentioned and Luis also mentioned, actually all of us mentioned, Munyoung too. It's all about generating growth internally, right, through productivity gains. And that is something where competition with some of these emerging markets can really help. Some competitive pressure, for example, through these trade agreements. India is a large market. It's not easy to do business in India, but it does help generate a bit of competitive pressure in Europe that can boost growth, even if export-led growth is becoming more difficult overall. Thanks. Back to you.
Thank you. So again, Francesca, yes, it's very important all economies need to prepare themselves internally. Productivity growth, demand growth, domestic demand is going to be important going forward, given that this period of uncertainty that we are seeing could be prolonged. I mean, it's difficult to say at this point in time. With that, I would like to thank all our panelists for their sharing their experiences and insights. This was very helpful. And I would also like to thank all our viewers for tuning in. Thank you. With that, we'll end the session. Thanks a lot.
Thank you so much. Thank you,
Thank you, everyone.
Thank you.
Bye.
Thank you.